Hi partner, I'm Sarah Carlson with Group D04 and we are so excited to take on this task of researching Stark Industries and their federal tax filing status. To begin with, I want to provide a bit of background. We are researching Stark Industries, founders Tony Stark, who owns 80% and plays an active managing role, while Pepper Potts owns 20% of the company and is a passive investor. They've already formed an LLC or limited liability company and have asked us to research which federal tax filing status would work the best for them. So we're going to dive into C Corp, S Corp, and partnership federal tax filing statuses. I'm going to hand it over to Patrick now to review these in detail.
Hey, Tony and Pepper. My name is Patrick. I've been asked by a few of my colleagues to give you a rundown of some options you have as a LLC and how you could file your tax returns. So kicking it right off, again, we have a few options here. You can start off as a C Corp or as a pass-through entity, an S Corp or a partnership. So what we're going to do is just highlight a couple of the key variables in that decision and then eventually give you our recommendation of what we think you should do. Starting out, C Corp, here's a good option. A lot of publicly traded companies are going to be C Corps. That's going to allow you to, as you guys have said, you want to sell the company potentially in the next 5 years. C Corps allow you to go public much easier than an S Corp or a partnership. You could have multiple shares of classes within a C Corp. So you could have preferred shares that have preference when it comes to dividend payments, or you could have common shares that don't have these preferences but maybe have different voting rights. So C Corps allow for these differences in share classes, whereas S Corps do not, and partners don't have shares within the company. Other restrictions on S Corps is that you can only have 100 shareholders and they have to all be US citizens. But perhaps the most important part, and one we'll harp on in other slides, is that the C Corp has this double taxation, both at the entity level as well as at the individual level for dividend income and then recognition of capital gains at a later date when you sell the company. Whereas S Corps and partnerships, they tax at the individual level and it's on ordinary profits and losses that flow through regardless of cash distribution. So something for us to be aware of and effectively tax strategize. Next slide, please. The next slide deals with the difference in the federal income tax calculation based on the 2021 management projections. And as you can see here, the C Corp actually minimizes the overall tax relative to the pass-through S Corp and partnership. And what we can see here as well is that there's this 21% federal stat rate at the entity level of the C Corp and then at the individual level. So Tony has two types of income. He has both wage income at the marginal tax rate, assumed to be 37% in this example, and then as well in the dividend distributions. These dividends are actually at a qualified dividend rate of 20%. Whereas for the pass-through entities, you can see where this is going to be taxed at the ordinary earnings and profits of the company, and it goes through to the individual. So Tony and Pepper have a much higher overall tax expense in the current year. Next slide, please. What this next slide is showing is that the C Corp, the after-tax cash take-home pay is going to be that $419,000. Whereas for the pass-through entities, if you go to the bottom right of the slide, there's an actual $72,000 cash deficiency. So this is where the cash distribution, if the pass-throughs is not necessarily the same amount as what you're being taxed on. And in this example, in 2021, we're actually showing a cash deficiency. So again, this is where effective tax strategies can come into play and something we're going to want to talk through over the continue talking about. Thank you very much for your time. So my colleagues now are going to talk through some other parts of this. Thank you.
Thank you, Patrick, and hello, Tony and Pepper. My name is Christian. We're going to talk next about organizational and startup costs. Section 195 governs the deduction and amortization of startup costs, and Section 248 governs the deduction and amortization of organizational costs. We can include a maximum of $5,000 of each of these categories for immediate amortization expense. Again, we'll talk about some specifics as we get into the calculation. we anticipate that the company will begin business January 1, 2021. And by the start of business, the company will have incurred organizational costs of $10,000 and startup costs of $52,000. Let's talk a little bit about the difference between the two. Startup costs for a C Corp are defined as costs incurred investigating an active trade or business. This could be either for the acquisition or the creation of that business. Applicable travel, market studies, salaries associated with startup are included. Your organizational costs are slightly different. These are costs that are incurred while organizing your business. Costs could include legal fees necessary to write the operating agreement and negotiate certain key contracts, could include accounting fees, filing fees, and so forth. Now, it's important to remember, again, we can deduct up to a maximum of $5,000 in each of these categories immediately. But if the respective category exceeds $50,000, then the amount that we can immediately deduct will be reduced dollar for dollar for that overrun. So we have run our calculation so that we will be able to have an immediate deduction of $8,000 and then an overall amortization of an additional $3,267 plus $333 for organizational costs, for a total year one amortization of $11,600. We anticipate, if you'll look down at the chart below, that in years 2 through 5, we would have an additional amortization of $3,600. A little more information on how the numbers were calculated. Again, we anticipate that we can immediately expense $3,000 of startup costs. That would be our $5,000 cap minus the difference between the amount of those costs, $52,000, minus our cap of $50,000. So we come up with $3,000 immediately, and then we just amortize the rest over 180 months. And because we start in January, we have 12 months of amortization expense that we can include. Organizational costs are the same, but because we only have $10,000, we can immediately expense $5,000 of those costs. Thank you for your time.
My name is Holly Walker, and I wanted to just talk to you for a little bit about switching your filing status after you have started your company. So based off of however you start your company, you may want to switch to a different filing status after you've gotten started and you see that there are some benefits to maybe some of the other statuses. There are a couple of different ways that you could do this. If you are trying to go from a C corporation to an S corporation, there's a file form that you do need to do, and you need to make sure that it gets done in a timely manner, including having all signatures and documentation given by the specific date. Once you accept it, you file your last C corporation return, and then you file your S corporation return, and the S corporation return will signal the change. That file, Form 2553, looks like this. You would click on this one right here, fill out your information, and then this is just a little bit more information explaining the way that you would go through all of this, including the signatures and what you would need. The IRS is extremely diligent about making sure that you do get this done in a timely manner, but if for whatever reason you do not, they also have some different things that you may have to do on top of just filing this particular form in order to get it changed. That again is going from a C corporation to an S corporation. In order to go from an S corporation to a C corporation, it takes a little bit more work. You would have to create a revocation letter to revoke the S corporation classification. And then I've got the following included of everything that you would need to have in it. The due date itself is going to vary based on the expected date that you would do the revocation on. Then you would fill out a new form 8832 for your new classification. And just real quick, this is what it would look like, what you would have to include in that letter of revocation. It has all of these different pieces that you need to. And then after that does have this specific due date. The due date goes based off of either the first day of the tax year, the 16th day of the third month of the tax year, or any time after that. The last potential that you may end up having is going from a corporation, so either a C Corp or an S Corp, back to an LLC or just a partnership. So the first thing that you would have to do is you would have to establish the new LLC, and then you would have to dissolve the corporation and distribute the assets and liabilities equally to all stockholders. Immediately after those stockholders have the assets and liabilities given back to them, they would have to contribute all of those assets and liabilities to the newly formed created LLC, and then once more fill out that Form 8832 for a new classification. So if you choose to switch based off of whichever filing status you start with, all of this should give you enough information in order to be able to make the change that you need to. If you do ultimately decide that changing your filing status would be the greatest benefit for the company.
Hi, this is Senthil here. I'm going to talk about tax consequences of selling a business. When selling your interest in a business, you must consider a number of factors. One very important factor is taxation. Typically, when you will sell your interest in the business to others or to your corporation in return for cash or property, this will result in capital gain or ordinary gain or sometimes losses. The tax consequences of selling your interest in a business depends on the type of business entity. The sale of corporate stock is usually taxed at capital gain or loss, although certain redemption of your stock would result in dividend treatment. The sale of interest in a partnership also usually taxed at capital gain or loss, but certain payments of unrealized receivables and inventory items may be taxed at ordinary income or loss. Note, the long-term capital gain and qualified dividends are generally taxed at 0%, 15%, 20%, or sometimes more, depending upon the taxable income of the taxpayer. Now let us see the tax impact of different type of business entities. If it is a C corporation, generally the sale of your stock in a C corporation result in capital gain or loss. Thus, the sale to another person or another entity other than corporation typically result in capital gain or loss. The downside of a C corporation is that they are subject to double taxation. The corporation is taxed on entity level profit, and then shareholders are taxed again on dividend distributions. The dividend distributions are not deductible to the entity, hence double taxation issue. S corporation, in generally, the sale of stock in a S corporation is treated as same as the treatment of sale of stock in C corporation, whereas the redemption of your stock by S corporation is treated as a dividend. There are restrictions on ownership structure. For example, S corporations are limited to 100 shareholders. This may be a limitation for some scenarios, but not in our case. Partnership, generally sale of your interest in a partnership result in capital gain or loss. However, certain payments of unrealized receivables and inventory terms are taxed at ordinary income or loss. Thank you.
Hello, Tony and Pepper. My name is Dan Lee. After listening my colleague's presentation, I think you may have an initial idea on how to choose entity as tax position. I will now explain to you how different company entity will affect your tax situation if the company has business losses, especially in the early days of the company's operation when it's more likely to face business losses. If the corporation is operated as a C Corp, no tax benefit is obtained from the losses until the corporation generates taxable income. In other words, there isn't allowed business losses deduction until your company have taxable income, and there are limitations under CARES Act. NOLs arising in 2021 and later could offset up to 20% of that future year's taxable income, and thus NOLs can be carried forward to indefinitely. If the corporation is operated as a partnership or S Corp, the losses of a partnership or S Corp are passed through to its owners, but it's subject to basic limitations. The at-risk limitation of Section 465, the passive activity loss limitation rules of Section 469, the business loss limitation of Section 461, and the potential limitation as a NOL under Section 172. If the losses have successfully escaped from these limitations, the losses may be available to offset other items of income at the business owner's level. Now we will look into regulation of how to deduct partnership losses. In general, under Section 704D, partnership losses is allowed only to the extent of the adjusted basis of such partners' interest in the partnership. If losses exceed the offset basis, then carried over to the next year. If a shareholder is allocated an item of S Corp loss or deduction, the shareholder must first have adequate stock to claim that loss or deduction items. Under Section 1366 D2, any loss suspended because of lack of stock shall be treated as incurred by the corporation in the succeeding taxable year with respect to that shareholder. In summary, losses of pass-through entity generally flow through to its owners and are deductible by them. In contrast, net losses incurred by a C Corp accumulated as NOLs may be offset future income of the corporation but are not available for use by shareholders.